NVIDIA just dropped a bombshell earnings report, stock soaring after hours. Let's break down the numbers and what this means for investors so you know how to profit. Hey everybody, welcome back. I'm going to make this short and sweet and get to the point. I'm going to show you some research before and then what the earnings are so you can understand the positioning of retail and institutions, how this looks after hours and what the key levels are so that you can profit from it, or at least have the information that you need to make a more informed decision. So this is clipped from an investment bank, and there's one thing in here that I just want to point out. This investment bank points out that the micro setup means that the print goes less smoothly than evidence. So in other words, what they're saying is a high implied volatility is out there in the earnings, and we saw that with the surge. You had a surge in put volume yesterday in the SMH where you had 121,000 puts on the tape. The 20-day average into this is 43K, which means all these people just got crushed and they're all out of position for tomorrow. So the 19K that's normally bought, which is 20-day average, is 26K. So this tells you right now that people are out of position, but it gets better. Retail sellers throughout the day, net selling, were selling 1.2 billion of stock. That's a 3.7 Z-score. Now, a Z-score, for those that have watched the Saturday video, Z-score, think standard deviation. So one standard deviation is about 67, two standard deviations 95, three standard deviations 99.7. So this tells you how out of skew retail is on NVIDIA. This information will help you tomorrow when you're like, why is this moving up so much? Well, retail's completely either net short or on the wrong side of this trade right now. We're going to get to that. With the cohort of net sellers of the NVIDIA, we still like playing for the market upside in and out of the print. And so they give you more perspectives, but I just thought that this will help you understand why the move may continue. As always, subscribe to the channel, click all notifications. What we go over here is really timely. It comes out at different times. You can see that, by the way, this is coming out in the format that this is coming out. Let's get to it. So the sentiment right there is frustrating to the buy side. Why? It's a tough quarter to decode. And the bottom line was this H20 export ban. The devil's in the details. And this is really what we're going to get to in a minute. H20 export ban, when China, can they sell to China? Can they not sell to China? Well, this was looking at a top line hit of 7.6 billion to the top line. Yet a few sell side analysts updated the numbers into the print to reflect any loss whatsoever. In conversations with buy-side or institutions, that they haven't either. I flagged this as a concern and risk, and this could lead to a choppy print. It's actually exactly what it did. Now, this is where it gets super interesting. So this is from JP Morgan and how they saw it. JP Morgan saw it at $43 before the H20 cut. After the implied cut, they left it at 43, and then it dropped it down to the consensus of 43.3. Survey results were 43.92. So the whole street was at 43.92, even though they cut because of the H20. The survey versus the implied cut was 920.92. I think this is fascinating because you can even see here going out to 26. Now, what's really interesting is JP Morgan before the cut, after the cut, took it down to 40. This is where they were on where you should have seen revenue come in. Super important when we're about to get to. Just remember this and you can click back to it. Look at where the survey result was, 45.47. So their concern was everyone that they spoke to, revenue guide 45.46. And this isn't from JP Morgan, it's from another firm. But what's interesting is they're coming out and saying the street, the buy side, the institutions, they're saying you're going to come in at 45.46. What's retail doing? Selling at 3.7 standard deviation to get out of the trade. There's also an issue of the margin. Watch where we're going to go with this. A third of the survey responded do expect gross margins of 58%. Sell side still at 71. 2/3 are clustered between 65 to 72. It's tough to reconcile. They had no idea. Where do we get into this? Now, for those that watch this closely, you will remember Oracle came out and said, hey, we're going to take about $40 billion worth of chips, not to mention the new CoreWeave deal. So you had something that could fill the gap. And then the numbers start coming out, excluding the 4.5 billion charge. So if you go back, you'll remember that charge was 7.8 is what they were thinking, 4.5. First quarter non-GAAP earnings would have been 96. So they would have crushed, absolutely crushed. And on top of that, the charge was significantly less than they thought it was going to be. And if we look at the headlines right here, 81 cents versus the 88, but that's them putting in that entire charge. And this is where people got confused by the quarter and why it took a while to lift. After you start looking at the revenue beats, which was pretty clean, there's a pretty clean revenue beat. but you had the gross margins. If you strip out the gross margins, revenue 44 up 12, data center 39.1, and this was actually in line for the first time. And what people couldn't understand was why. Well, it was in line because of the big charge-off. So once you strip out that charge-off, they get into it right in here. 4.5 billion charge. They were looking for that 7.8 charge, so it was, I'm not going to say it was half, but it was a third less than expected. Sales of products were 4.6 in the first quarter prior to the new export licensing requirement. Nvidia was unable to ship an additional 2.5 billion in the first quarter. And the devil's always in the detail. And this one line was really important. If you take out the 4.5 charge related to the tax and the tariff, the charge they had to write down, they came in at 96 cents. They absolutely crushed. Now, the street understands the charge and doesn't care so much about it, but they care about forward guidance. And it was that forward guidance that pushed us forward. So when they started breaking this down on the fiscal year, you can see the gross margins. And then what they did on the sheet was they showed the gross margins had they not had to take that write down. And when people started getting this, they're like, wait a minute, they're not in the high 50s, they were in the low 60s, and without this, they came in at 71.3. Now, that's not where they were before, and obviously gross margins are coming in, but it's still a 7 handle, which is pretty significant. This is what they're focused on, that 7 handle. That's why the stock lifted. And you remember the guide that we went through, look where they came in, 45 billion was the guide. That's really important because they weren't expecting that. When you start getting through that, the outlook reflects the loss of revenue of 8 billion due to export control limitations. So just so we're clear, their revenue guide is 45 billion, and that reflects a loss of 8 billion stripped out of the quarter because H20 can no longer go where it's supposed to go. So this number is an absolute utter crush. Just think about that. They took out 8 billion of this number and they still came in line with street estimates. And then look where they're looking at the gross margins. They're saying that gross margins are actually going to go up. Remember we saw that 71.3, now they're at 71.8 versus 72. I know this is super technical before we even get into the charts, but it's these little details that when you don't understand this stuff, this is why the stock goes up and people say, oh, it's fixed. No, you just don't understand it. And understanding these little nuances makes all the difference in the world. Now, I'm just going to take a second to show you, we had a position in this much earlier and we had calls going into this, but there's still trades after hours when you understand this stuff. So as soon as we're watching the time, because you know it's 4:18, 4:20 comes out, you read it, and then you just start going through it. You're telling the times, good quarter, still in from the buy. I just timestamp where it is. And then you'll see here already, I'm shooting for where my targets are. Super important. From there, as news comes out, we just keep moving the stop up. We allow the trade to kind of set itself up. We move the stop up to this level. You can just see the timestamps here. And what I'm doing is, I think it's good, but that doesn't mean that they don't sell into it. Right? They just might want to sell into it anyway. You just don't know yet. And if you're interested, I'm going to do a video on it, but it's pattern recognition. So you see how this bar straight, then this one fits inside with that doji. So there's patterns within patterns. So the first pattern's traded and that's on, but that doesn't mean that you can't find multiple entries in the same trade. It's super important. So I have an inside bar here, I get another inside bar, and these are still there for those that are looking for Nvidia. And then you have this forming sitting in there. And so what I'm saying is you have an inside bar, possible double inside bar, and you're gonna have to watch the spelling because I spell tweet, talk, and trade at the same time. And you can see that develop into that double inside. Once you see it develop and then you flip over, that's supposed to be here. Here we go. So now you know that that's the next entry. And all you're doing is you're entering there and you're using the low of the previous bar as your stop. If there's enough interest, I'll show you how to do these or how I do them. Maybe you do them differently, but these double inside trades, they're pretty powerful. And then what we're doing is buying it, and then that becomes the stop. And you can just see everything here in the timestamps. And if not, just use this as a timestamp. But you can see how it's developing. And what we're doing here is we're allowing it to develop, pull back, develop, and then we're trimming into those previous highs so that we get positive slippage. And to be clear here, these are multiple day trades, inside swing trades and calls that we already have going on. So you have multiple trades inside the same trade. Right? It's not just the swing trade. There's the swing trade. There could be the options that are in there as well. There could be multiple day trades in there, and they all have their different levels. The goal is to maximize profits off one trade, off one idea as much as you possibly can. But I'm keeping the target of that 42.60, which is going to become really important in a second. But when I flip positive slippage. You sell into positive slippage. This is me just making jokes. And then we're going into the call. I have not listened to the call. I wanted to get this out to you guys ASAP. And then our targets hit right in here. You can see that little doji up here, but that was our line. And the next is 44.60, and there's nothing wrong with trimming. Now, this is why. You never know how this is going to be perceived. You never really know how this is going to go and how they're going to view the tape. So that was our level. You don't know what he's going to say. You don't know what the CFO is going to say. But for me, I think it was a really good quarter. And I think that you're going to see the other names respond to it as well. I'm going to keep this short, not get into the other names. I'm going to do it pre-market tomorrow because I want to get this out as soon as possible. That is it.